All right, here we go again. I just came across another headline on the front page of a major news site. The article is titled, "The Stark Reality of What a 1.5 Million Retirement Looks Like in 2026." With a title like that, you already know I had to read it. And honestly, before I even finished the first paragraph, something felt off. A stark reality? That framing alone told me where this was headed. To be fair, that is not the most unbiased way to approach an article. But after reading the whole thing, my instinct was right. This piece is poorly framed, the math is misleading, and it falls squarely into a pattern we see constantly. The idea that no matter how much you have saved, it probably is not enough. Hey everyone, I am Erin. Welcome back to the channel. Here is the specific moment that stopped me cold. The article states that if you take a 4% withdrawal from a $1.5 million portfolio, you get $60,000 a year. Fine, conservative assumption but reasonable so far. Then they follow it up with this. After federal taxes, you are only left with $46,800. And right there, I had to put the article down and walk through this carefully, because that number is not just slightly off. It reflects a fundamental misunderstanding of how taxes actually work in retirement. Let us start with the tax math, because this is the most glaring problem in the entire piece. If your $1.5 million is sitting in a traditional 401k or traditional IRA, then yes, withdrawals are taxed as ordinary income. That part is accurate. And yes, a $60,000 income could technically push you into the 22% federal bracket based on 2026 tax tables. But here is where the article completely falls apart. It assumes you pay 22% on every single dollar of that $60,000. That produces a tax bill of $13,200 and leaves you with $46,800. And that is simply not how our tax system works. We operate under a progressive tax system. Your first dollars of income are taxed at the lowest rates. Only the portion of income that reaches the upper brackets gets taxed at the higher rate. You are never paying your top bracket rate on your entire income, only on the slice that sits within that bracket. And beyond brackets, there are deductions, which the article ignores completely. In retirement, those deductions are actually more generous than most people realize. As of 2026, retirees age 65 and older qualify for 3 separate layers of deductions. Layer 1, the base standard deduction. For single filers, $16,100. For married couples filing jointly, $32,200. Layer 2, the age-based add-on. For single filers 65 and older, an additional $2,050. For married couples, $1,650 per qualifying spouse. Layer 3, the new OBB senior bonus deduction. $6,000 per person for those 65 and older, whether filing single or jointly. Add all 3 layers together, and here is what you get. A single filer age 65 or older qualifies for $24,150 in total deductions. A married couple where both spouses are 65 or older qualifies for $47,500 in total deductions. Now let us run the actual numbers. A single filer age 65 or older with $60,000 in ordinary income, after applying all eligible deductions and running it through the correct progressive brackets, walks away with approximately $56,000 in after-tax income. A married couple, both 65 or older, with the same $60,000 in income ends up with just under $59,000 after taxes. The article says $46,800. Reality says $56,000 to $59,000. That is a $9,000 to $12,000 difference right out of the gate before we even factor in Social Security, income strategy, or any intentional tax planning. That gap matters enormously, and this is before a single dollar of optimization. Now, could taxes be higher than what we just calculated? Absolutely, if you have additional income sources stacking on top. But here's the piece the article completely glosses over. If your taxes are going up, it means your income is going up too. That is not a problem. That is actually a good thing. Let us add Social Security and look at a realistic single-person household. We will assume this individual collects $2,000 per month, $24,000 per year. Add the $60,000 IRA withdrawal, and total pre-tax income is now $84,000. Now, Social Security is not taxed the same way as ordinary income. It is governed by what is called provisional income, a formula that determines what percentage of your benefit actually becomes taxable. You do not automatically owe tax on the full amount. In this scenario, a portion of the Social Security does become taxable, and because total income now exceeds $75,000, part of that new senior bonus deduction begins phasing out. So yes, the picture gets slightly more complex, but does it suddenly become a high-tax situation? Not even close. For a single filer, age 65 or older with $84,000 in total income under this scenario, after-tax income lands at approximately $77,000. The effective tax rate is roughly 8.5%. That is the real number. Even after Social Security layers in, after part of those benefits become taxable, and after losing a portion of the senior bonus deduction, the effective tax rate is still under 10%. Now let us go one step further and look at a married couple, because this is where the numbers get even more interesting. Both spouses claim Social Security at full retirement age. Each receives $2,000 per month, $48,000 combined annually. Add the $60,000 traditional IRA withdrawal, and total household income is $108,000. At this income level, 85% of their Social Security benefits do become taxable. That is the maximum threshold. However, importantly, this household does not hit the phase-out range for the new senior bonus deduction. They keep the full benefit. So what is their federal tax bill on $108,000 of household income? Just under $6,000, an effective tax rate of approximately 5.4% of WISE. Let that sink in for a moment. This couple has over $100,000 in annual income, and their total federal income tax bill is less than $6,000. Compare that to what the article claimed, that a single person earning just $60,000 would only keep $46,800. This married couple is earning nearly double that amount and still paying less in taxes. That is not a minor discrepancy. That is the complete opposite of what the article implies. And the reality is that most retirees are not drawing from a single account. They typically have Social Security, perhaps a pension or annuity, potentially some part-time income, and possibly a mix of traditional, Roth, and taxable brokerage accounts. Each of those sources carries different tax treatment, and the combination often creates a far more tax-efficient picture than any single-source scenario suggests. Roth withdrawals, for example, are completely tax-free. Long-term capital gains from a taxable brokerage account are taxed at preferential rates, often 0% for retirees in lower brackets. When you layer these sources thoughtfully, households with $1.5 million in retirement assets are very likely to have both more income and a more favorable tax environment than this article implies. Now let us talk about withdrawal rates, because this is where the article subtly shifts the narrative in a way that deserves pushback. The piece suggests a safe withdrawal rate in the range of 3.5% to 4% for a 30-year retirement. To be fair, that is not unreasonable. It aligns with traditional retirement planning guidance, but then the article goes further, suggesting you should consider part-time work to drive your withdrawal rate down toward 3%. I want to be clear about something. I am genuinely supportive of phased retirement. If part-time work brings you meaning, structure, and extra income in the early years of retirement, that is a great choice. Reducing portfolio dependence early gives your investments more time to grow, and it can meaningfully strengthen a long-term plan. But the idea that you need part-time work specifically to push your withdrawal rate down to 3% for a 30-year retirement? The data does not support that as a necessity. Here is what the research actually shows. Forward-looking Monte Carlo simulations, which tend to be more conservative because they use current market valuations and lower expected returns, suggest a safe withdrawal rate of approximately 3.7% to 3.9%. For a 30-year retirement under a completely rigid, inflation-adjusted approach with zero flexibility. But that is the most conservative version of the analysis. Historical data on safe withdrawal rates for 30-year periods puts the number closer to 4.5% to 4.7% under modern assumptions. And if you introduce any degree of flexibility, skipping an inflation adjustment in a bad market year, temporarily reducing your withdrawal during a downturn, adjusting spending as life changes, even conservative forward-looking simulations support withdrawal rates of 5% or higher. Again, on a $1.5 million portfolio, the difference between a 4% and a 5% withdrawal rate is $15,000 per year. That is a significant income gap, and it directly affects how large a portfolio people believe they need. It is also worth noting that the data consistently shows most retirees naturally reduce their spending over time. They tend to spend more actively in their 60s and gradually pull back through their 70s and beyond. That natural drift toward lower spending builds an additional cushion into most retirement plans that static withdrawal rate models never capture. Now let us really stress test this, because if we want to know whether $1.5 million actually works, we should look at a genuinely challenging scenario, not a comfortable one. Most retirement planning assumes a 30-year horizon starting at traditional retirement age, but who actually needs a 30-year runway? Based on Social Security life expectancy data, men in their early 50s typically live into their early 80s. Women in their mid to late 50s typically live into their mid to late 80s. So a true 30-year retirement is most relevant for someone retiring significantly earlier than 65. Let us build that scenario. Retirement age, 55. Portfolio, $1.5 million, all in a traditional account. No other income until Social Security begins at 62. Monthly Social Security benefit at 62, $1,400 or $1,800 per year. Total planning horizon, 30 years. To access retirement funds before 59 and a half, this person uses the Rule of 55E, which allows penalty-free withdrawals from a 401k if you leave your employer in the year you turn 55 or later. We structure this in 2 phases using a simple bucket approach. Phase 1, ages 55 through 62. These are the bridge years. No Social Security. The portfolio is the only income source for 7 straight years. Using a flexible withdrawal strategy, not a rigid fixed rate, a $1.5 million portfolio can reasonably support 4.5% to 5%. Right in the middle at 4.7%, that generates just over $70,000 per year in annual income. Conservative? Yes. Could we draw more and still be considered within safe parameters? Absolutely. But let us keep this scenario conservative. Phase 2, age 62 and beyond. Social Security activates and brings $16,800 per year. The portfolio now only needs to fund approximately $53,200 as the gap. Look at what that does to the effective withdrawal rate. It drops to roughly 3.5%. That is a significant margin of safety and dramatically improves the long-term durability of the plan. So even under this stressful scenario, early retirement at 55, no outside income for 7 consecutive years, modest Social Security, this portfolio can still support $65,000 to $75,000 per year in sustainable income. So let me be direct about what this article got wrong, and there are 4 clear problems. First, the tax math is simply incorrect. Assuming a flat 22% rate on every dollar of income ignores both the progressive nature of our tax brackets and all of the deductions available to retirees. Those 2 errors alone create a $9,000 to $12,000 difference in what you actually keep. Second, Social Security is completely ignored. The vast majority of retirees will collect Social Security. That income source fundamentally changes the entire picture, both the income available and the effective tax rate on it. Any retirement analysis that leaves it out is missing the most important piece of the puzzle. Third, the framing around part-time work is off. Part-time work in early retirement can be a smart and fulfilling choice, but presenting it as a necessity to achieve a 3% withdrawal rate for a 30-year retirement is not grounded in what the data actually shows about safe withdrawal rates. Fourth, $1.5 million framed as fragile when it simply is not. With accurate tax math, the correct withdrawal framework, and Social Security included, a $1.5 million portfolio can support a retirement lifestyle of $70,000 to $80,000 per year from the portfolio alone. Layer in Social Security, and a household income of $100,000 per year is well within reach. One thing I would add that the article does not mention at all: if you are heading into retirement with $1.5 million sitting entirely in a traditional IRA or 401k, Roth conversions deserve serious consideration. Here is why. That portfolio will likely continue growing. Once required minimum distributions begin at 73, you lose control over how much you are required to withdraw each year. Those forced withdrawals stack on top of Social Security, can push you into higher brackets, and increase your IRMAA Medicare exposure. Executing thoughtful Roth conversions in the years before RMDs begin allows you to smooth out your lifetime tax bill, protect your Medicare premiums, and reduce the forced withdrawal pressure later in life. With $1.5 million in a traditional account, this is not a problem. This is an opportunity waiting to be optimized. What frustrates me about articles like this is the pattern. $1 million is not enough. 1.5 million is not enough. Even $2 million is framed as barely sufficient. And across every one of these pieces, the common thread is fear-based framing that relies on incomplete math and ignored variables. We do not need more fear. We need more accurate analysis, grounded in how taxes actually work, how Social Security actually integrates into the picture, and what the withdrawal rate research actually says. That is the conversation worth having. What are your thoughts on this kind of framing in retirement media? Drop your take in the comments below. I post new videos every single week. If this one gave you something useful, please give it a like. If you are new here, subscribe. And if you know someone who would benefit from seeing the real math behind this, share it with them. See you next week.